All right. Good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Uh, Go out and do a couple things here this afternoon. About an hour left in trading for the week for the market. There haven't been a lot of signals here this week. But there's some real change kind of happening in a lot of the stocks on the watch list. So I want to show those to you, talk about those, and kind of what it would take for them to signal. Here, as we go into next week, it is something where we could potentially see a heck of a lot of signals come in next week. But if we continue to see kind of the flatness in the market, kind of this neutral here in the market, we're probably not going to see a ton. Now we're 5 minutes or 4 minutes ahead of the last hour, but gonna go make the decisions here. Entry triggers, there are none this afternoon. Again, I'll show you kind of everything that's everything that's out there with the watch list here in just a little bit. But there are no new signals here this afternoon. To react to. The closest one was Alibaba, but Alibaba is down a little bit. If it were up about 50 to 70 cents, we'd be looking at a renewed bull signal, but it is not there. So Alibaba's stock is, the Alibaba position, it's time to get out. Why? Just the auto exit date. That is it. Right, just the auto exit date. So I'm gonna pop on out, and let's see here. I have the wrong one in there. Let's change that there, and this is Netflix. But if we come in and we look, we got in when the stock was at 187.97. And today the stock is 187.22. It's 70 cents different, for Alibaba with an average true range. In fact, here, let me pull up the average true range. With an average true range of $3.50 to go 3 days and only have moved 70 cents. That's a rarity, and that is consolidation, and that is flat, and not something I'm going to stick into here with it. So let's pull up the prices here of the options. We have two options to chuck here. One of them, the 10th of May, 187.5 calls. Right, these are going to have some time decay. So 10th of May, 187.5 calls. We probably exit them for about 360. 365 be probably not. So 360 will be the exit price. There we go. And it is closed. And let's come down here, trade exit 360, and it is closed. There we go. Now the 24th of May, 185 calls, right? 24th of May, 185. We're not going to have nearly the same time decay. 830 there as an exit price. So 830, and trade exit date is, today, right? There we go. Fill that in. And the trade is closed. All right. You'll see the dollar amount difference, right? From the shorter term option and the longer term option. Longer term options are going to be able to survive a little bit of consolidation. The shorter term options just won't. They just absolutely won't. And they take a much bigger hit when it comes to flat or just slightly move against. And, you can see the survivability, right? With the challenge so far, we've had very few signals. We've had 3 tradable for the 30 to 60 day. We've had 4 tradable for the 14 to 20 day. The 14 to 20 day is down to what, 1,300, right? In this kind of flat type environment and getting, just boat raced on a few trades, not very survivable, right? The longer term, much more survivable. Nothing going our way, nothing, doing anything, much more survivable, still much more in the game. And here's the thing, we still have all the upside potential in this longer term. Not as explosive, not as dynamic, but when we talk about when we run the challenge, the auto challenge live, this. Look, if all four trades, if all of the trades would go for us, right? I know what it would be. It'd be, man, all right, let's do the short basket. Let's do the short-term basket. Let's do the short-term basket because it'll be that explosive. But the sustainability comes in this longer basket. And then, hey, once the longer basket has some gains, fine. We take some of those gains and play them in the shorter basket and run. So that's, ultimately how it will unfold. But, we could kind of see that taking shape here with it. Really, we just need one trade to have one day go our way, and we're back in the green here in Test Basket 3. That's not quite the case in Test Basket 1 and 2. It would take a heck of a lot more than that. Okay? All right, so out there and heading into the weekend with cash on those due to a lack of signals. Now, lack of signals here this week, but there are a couple kind of big elements when it comes to the algorithm that are visual, right? And these are the two elements that you'll continue to hear me talk about. One of them is this stochastics 39.1, right? Basically just saying, is the stock price high or low relative to the last 39 days? And it's going to be very difficult for a stock to trigger bearish when this is above 50, and very difficult for a stock to trigger bullish when this is below 50. Okay, the whole premise of trading higher highs and higher lows to the upside and lower highs and lower lows to the downside, is where this comes from. And visually, this is just the easiest way to see it, or the closest to how it is in the algorithm. Now, this week we have a lot of stocks that are moving from above 50 to below 50 that are in the watch list. Let me show you a few. Here's FCX making this move from above 50 to below 50. Right? Now, it's making it on earnings. You're also going to see this other common theme. It's making it on earnings. Was it a trigger yesterday? It was, but like we have seen with several others, the move too drastic, the move too dynamic to suggest that the odds are in our favor of much further run. The bounce risk is just very high. And when it comes to those bounces absolutely kill. So, doesn't create a trigger, in terms of the challenge. Halliburton, same thing. Now, this one's just moving below 50 here today. It's not doing so on this kind of lower high. This has just kind of been straight on down. Never triggered, a trigger here. The last Halliburton trigger, hey, I actually played for the last challenge, but came right back in here on the last move below 50. We haven't seen a trigger come in yet, but we have this element coming where, move below 50. And when you look at Halliburton historically, when it moves below 50 on the stochastics, it gets ugly. It gets ugly pretty fast. IBM. You'll notice Halliburton had earnings this week. So did FCX. IBM had earnings last week. Gapped on down, right? Wasn't a trigger, but you can kind of see what's starting to unfold, what's starting to shape up here. This kind of flat to, all right, starting to kind of roll back down. There's a potential that this triggers. It didn't trigger today, but we could see this trigger as early as Monday. We do have the stochastics 39.1 starting to push below 50, which, increases the chance of that coming in. But again, earnings gap, in that data. Triple M moving below 50. Earnings gap. Ammo, Altria, moving below 50. Earnings gap. Schlumberger, moving below 50. Earnings. AT&T, moving below 50. Earnings gap. You get the picture. UPS, same thing. 1, 2, 3, 4, 5, 6, 7, 8. 8 out of the 50 stocks, right? So 16% of them all have this same dynamic where they move below 50, but move so fast, so quick, and so heavy that we don't get a trigger. But they are changing their nature. A lot of these are some where if they rally and then start to fade, they would definitely create downside triggers here. So stuff that's been on upward trends, in no danger or no possibility of creating a downside trigger, now have a lot of that potential. But this isn't all of them. We have a few others in the watch list that are kind of doing the same thing on this gap, but don't have the stochastics moving below 50. What they do have is a downside 3-7 crossover. Things like a Walmart, things like a Target. So a lot of gaps for stocks in the watch list to to deal with or to kind of consolidate, but changing the nature or potentially changing the nature of several of the stocks here on the watch list. Okay, so we'll see how next week shapes up. I would not be surprised if early Monday morning we get a bull signal on Alibaba and boom, time to go. Jump back in and play the next leg up. But it's not there here this afternoon. So just moving on out based on that time element. Okay. All right. I want to talk about the SPX trade, or this idea of shorting the market right here. This morning was discussing with one of you this idea of market puts, and some long-term market puts, and what month to choose and what date to choose and all of that. And I said I'd comment here on video, and so I need to make sure I choose my words properly. You could go buy puts on the market right here, but there's no difference in buying puts on the market right here than there was right here, than there was right here, than there was right here. There's no difference. There's no real technical difference. There's no real overbought, oversold difference. There's just, it's the same type of trade. It's speculative that we'll have a pullback. Now, buying puts right here is a little bit different. Now we have action that historically has proven that it can be followed by some big drop. In this case, it wasn't. Same with right here, and it wasn't. But the odds are much greater in your favor that you're going to get downside action off of these types of moves than off of what we see today. I understand the temptation to top pick. I understand the temptation to be able to say, you know what, I just absolutely nailed the top. And ultimately, if you go buy puts today, you could. But the odds are not in your favor. They're simply not in your favor. When we see tops come into the market, when we look at this last pullback, you'll notice there was actually at least an equal high. All right, there was a pullback and then kind of retest where, all right, buyers failed to gobble it up, and then a pullback into some new short-term lows. You'll notice all that happened before the big carnage. Almost every single market pullback we ever go and look at. Let's go to the flash crash, right? That came out of nowhere, apparently, and it was one of those where, okay, if you weren't in ahead, then you didn't get to take advantage. No, not at all. Here's the flash crash. This is the flash crash right here. Notice what happened. We get a market that has some downside in it, pops back up. Here we're still higher high. Pop back on down. We pop back up. Oh, a lower high. Now pushing into a lower low. Was that too late to get in? No, it was definitely not too late to get in. And it is a point where the odds are significantly more in your favor. Getting in right here, just because you think the market's overbought, does that make a heck of a lot of sense? You could be right? You could be right. But the odds are not in your favor in the same way. The time to top pick on market puts is not when the market's hitting new highs. The time to top pick on market puts is after rallies when the markets hit new short-term lows. That's the time to top pick. That's the time where the odds are much more in your favor. For example, let's just go fast forward a year into 2011, right? Here we have the market pushing on down, breaking into new short-term lows, gap on down, short-term lows, gets a nice pop, right? These pops are the odds are much more in your favor that, hey, you're going to get some downside. We push into new lows, now we get a pop, we get overbought. You know what? Say you buy the puts right here. Say you buy them right here. You know what? Chances are they'll eventually pay off. You may have to ride some more upside, but chances are pretty good they'll eventually pay off. You could be right. Here we go. Up and away here in February. Hits a new high this day, and then big gap down and go. And if you weren't in puts, ouch. It's hard to chase that day. But did you get other opportunities to get in? Yeah, you did. Right? So, the odds just are not in your favor when you're talking about a market hitting new highs of saying, hey, you know what? If I go short now, I'm going to be right and right soon. Couple exceptions to that. One is when you have some sort of big reversal. High volume, big reversal type action. Another is when you have this type of candle action. A hammer, where the market gaps up, sells off, and rallies all the way back. You get this type of hammer. A lot of times these are tops. We see one right here at the end of May. But those are where the odds are in your favor, not in what we are seeing today. Not in this just kind of, hey, market just moseying on up to new highs. Here in 2012, take a look, January, February, March. The market's overbought. Market's overcooked. But take a look. Yes, we get a pullback in April. And then there's this kind of little consolidation here. Market not doing a heck of a lot. Starts to rally again. Lower high comes in. Starts to break on down. There's your opportunity. And in fact, if we go a little further, here we go. This is May. This is that lower high. You'll notice the selling action off that lower high is significantly greater than the selling action off of the brand new high. We even get that at the end of the year. Lower high, lower low, right? Yes, if you're not in today on market puts, could you miss a big down day? You sure could. Are you going to miss the majority of the trend? Not likely. The odds are very slim of that being the case. And so, you say, in terms of timing, when is it time to put those on? Well, it's time to put those on when you start to see the metrics shift and when you start to see some confirmation into the metrics. For me, bottom line is it comes down to the market vibe. And if I come in here to the market vibe and, I'm told you all have access to this now, so great. You come into the market vibe, you see it's trending neutral. Are we going to see a big drop in the market when it's trending neutral? Not normally. In fact, you look over the last since 2015 on aggregate, what the data shows, neutral days, average daily gain 0.1%. Significantly greater upside on bullish days, significantly greater downside on bearish days. We see that happen year after year, and not only on aggregate, but there's not a year where that isn't correct. Here's 2018. We see the bullish days much bigger average daily gain, and the neutral and the down days. Neutral is much flatter than the bullish or the bearish, and the bearish is much further down. And so we see that stack each and every year. Since the inception. And so what's that say? It says when you start to see a bearish signal come in, that's the time where the odds of having those big sharp downs, those retracements, those heavy moves are significantly greater. And yes, is there whipsaw risk? There always is. That never goes away. That never ceases when it comes to the market. But if you want to put the odds in your side, right, and you want to go and say, hey, I want to short this market right here, the odds aren't in your favor right here. They're simply not in your favor. Could the market be at a high? It could, but you might be dealing with another month or two of consolidation before, a next move lower, right? A lot of, speculation when it comes to things like that. And so, I just encourage a little bit of patience with it. I understand it. I get it. I see where it's at, but I do encourage some patience there. And then if you're going to go for it, now and try to top pick, take a look at some put spreads. Some put spreads with plenty of time. That way, you can ride a little bit of wave, right? I got into some put spreads right back here on this move. I'm still in them. I put what I was willing to risk, right? But I still have plenty of time on them. And you know what? If the market decides it wants to roll over, they're still going to pay off, and they're still going to pay off big. And I can still hold consolidation and still wait for that. And I don't have to sit there and go, well, oh, man, is today the day or is tomorrow the day? Or, we saw earnings out of this company, so does it mean, CAT wasn't that great, so are we going to go down now or now? No, I can let the market forces continue to drive. And so if I were to go set up some downside position right now, which I'm not, because I don't have even, what I had back here for me to add to downside or add some downside market SPY-wise. I need to see at least a lower high or some market vibe erosion or something of that nature. And right now, all we see is that continued neutral, that continued consolidation. Yeah, we see sell-offs in the market, and if you look at them on a short-term basis, on a minute chart, right, S&P minute chart, and you're watching them in the morning like this, and you see this sell-off, man, that looks huge. Market just dumped 13 points. It's pretty meaningless, right? 13-point move in this market, pretty darn meaningless. And, so, yeah, I get it. I understand it. But, as far as when is the time to set up, it's not right now. It just isn't. In terms of having the odds in your favor. You could go at it. You could be right. But you don't have the odds in your favor, to be right anytime soon. Okay? All right. Last but not least, gold. I was asked about gold here, and, we have had a little uptick here on gold. It hit into new lows, right? And we talked about this, hit into new lows, broke down into some new lows here, and is snapping on back. What has gold created here? It's created a bear trap, right? We get the breakdown, the lower highs, lower lows. This thing's going to melt. This thing's going to die. It's going to break on down. Price targets are down here. Nope, snap right on back, break back above that support level. This is a bear trap, as good as they come in terms of just setup. Right now, ultimately the outcome will dictate. Did not get any signal for the challenge for GLD. You'll notice where the Stochastics 50 is. It's still down here on 20. We're still dealing with lower lows and lower highs, so chance of getting a signal on that are very slim. On the stock, here GOLD, right? You'll notice it's below 50. We're not going to get a signal right away. I think it's a pretty nice setup right here, buying it off of the lows of this week. And playing GOLD higher off of this week's lows just from a setup, but in terms of an algorithm signal, just doesn't have it. But, we do see a bear trap here being sprung by the bulls in gold this week. And ironically, it corresponds to some very, very ugly action in oil over the last 3 days. Not too surprising that after a weekend where we get a lot of analysts talking about $80 oil, a lot of traders talking about $80 oil, that we see oil have one of its worst weeks of the year, or the worst week of the year, when that speculative talk has mounted and ramped up. Okay. Thanks for hopping on. Have yourselves a fantastic weekend, and we'll talk to you Monday morning. Take care.